This is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, February 16, 2024. On Tuesday, we learned that the Consumer Price Index for all urban consumers, sometimes referred to as headline CPI, rose 0.3% in January and grew 3.1% over the previous 12 months. Excluding food and energy, the core CPI increased 0.4% last month and gained 3.9% during the past year. So here's the news release from the U.S. Bureau of Labor Statistics. Over here are the numbers. Very top number is the headline CPA. Come down here, all items less food and energy at core, you'll see the 3.9% there for the trailing 12 months over there on the right. All those numbers were a bit higher than expected, but not enough to set off alarm bells on Wall Street. After a small drop that day, the S&P 500 index fell in response to that unwelcome news. But by this afternoon, the index had recovered nearly all that loss and was only a few points below its all-time intraday high that it hit last week. So I'll show you a chart of the S&P 500, which I do pretty much every week. Here's the past 6 months. So clearly you can see it bottoming out here at the end of October, and then a very nice upward trend. But let's now look at year to date. You can see here on the right, this is basically the past week where I have the cursor now. This drop right here was when the CPI report came out, but then it bounced right back and was very close to those levels and might even exceed them by the time today is over. Now, also rising was the yield in the 10-year Treasury note, which rose above 4.3% that day after starting this year below 4.0%. At this point, the likelihood of a Fed rate cut next month is about nil. In fact, most Fed watchers believe it will not be until the second half of this year that the first interest rate cut in more than 4 years might take place. So let's take a look at the yield curve here, and I'm going to talk about this again in a moment. But right down here, third one from the bottom, there's the U.S. 10-year, and right now it's at 4.297, and this is around 2 p.m. on Friday. So that's worth noting. In fact, as I note in my cover page article of the new edition of Personal Finance published to the website today, the good news is an interest rate cut may not be necessary to keep the economy growing. Thus far, producers and consumers have adapted to higher interest rates without a drop in productivity or consumption. Now let's hope that remains the case, because at this point, that is the primary reason the stock market continues to go higher. Unlike 4 years ago, when the Fed reduced interest rates to almost nothing to keep the economy afloat in the wake of the coronavirus pandemic, investors now have a viable alternative to stocks in the form of bonds. You might remember the acronym TINA stands for There Is No Alternative. Well, 4 years ago, when bond yields were well below 1%, a lot of people felt it was either the stock market or nothing. But that's not the case now. You can get good yields on bonds. In fact, we are now, once again, back to an inverted yield curve. This morning, the 3-month, and here, I'm going to go back to this page here so you can see as I'm talking. But this morning, the 3-month Treasury bill was yielding 5.4% compared to a 4.5% yield on the 30-year Treasury bond. That means the bond market is expecting a recession soon, even though the stock market continues to climb higher. Now, something has to give. Either bond yields will start coming down as it becomes increasingly apparent that a recession is not in the cards, or the stock market will weaken as the Fed starts contemplating a rate hike to cool off inflation instead of a rate cut. Now, nobody's talking about a hike yet, but they may start talking about it soon. And as soon as they start talking about it, that's when the bulls on Wall Street might start thinking twice about their enthusiasm for stocks in the short run. Now, given what we know now, I believe the odds of a stock market correction during the first half of this year are about 50-50. I'm not expecting a crash, but a decline of 10% would put the S&P 500 index back to where it was 3 months ago when it appeared inflation was under control. So if we go back to this chart of the S&P 500, we go back 6 months. Now right now it's just a little over 5,000. So a 10% haircut off of that would be 4,500. And as we go back down the curve, we hit 4,500 back here around mid-November. And that's just when Wall Street was really starting to embrace the idea that, hey, the Fed's done raising rates, and they might start cutting in March of 2024, given what we knew then. Now, if we do get that correction, I would view it as an opportunity to buy stocks that are currently fully valued and have good long-term growth prospects. Bear in mind, the S&P 500 index is up less than 10% from where it peaked a little over 2 years ago, shortly before the Fed began raising interest rates. So if we go back 2 years on the S&P 500, and I'll even go out 5 years to make it a little easier to see. Here we are now. Here we were a little over 2 years ago. So, most of the stock market's rally over the past year or so has really just been to recover what it lost after the Fed started raising rates. So that's where I see the market right now. But the way things are going, who knows a week from now what the story may be, but that's how I see it today. So enjoy this weekend, and I look forward to talking to you in another week.